how do we help investors make a determination on how they allocate capital between, say, the growth parts like equities and higher expected return and higher volatility asset classes, and the defensive like fixed income and cash? How do we help investors make that determination, do you think? What is the best way to do that?
Yeah, I think you framed it well, where you have risky assets and you have risk management assets. And there's some conventional wisdom that people will appeal to when they think about how much to hold of each and how that varies through time as you go from, a youth or ute, as they might say, where I'm from. And then in the future, as you start to approach retirement, believe it or not, there actually is theory behind this. So it really comes down to when you have two kinds of assets that you're going to be using to fund your future liabilities, if it's retirement or some other obligation you have in the future. And those assets pretty simply are your financial assets, so your investment portfolio that you have, the stuff that you've purchased. And you also have your human capital. So your human capital really just simply means my ability to continue to work, to earn a paycheck, to save more and contribute more to my savings that are going to be used for retirement spending. And what you see as I proceed through my investment journey, I start to deplete my human capital. I'm not going to work forever. So as I start to approach retirement, my ability to continue to work, save, and contribute to my portfolio, to my financial assets, is dwindling. And at the same time, theoretically, if I've been saving along the way, my financial assets are starting to become a larger portion of what I'll call my overall balance sheet. And so this is where you see what the implications would be for my composition of my financial assets. When I'm young, and if I have a long way to go to work, then the majority of my overall assets are my human capital. I'll probably have a paltry number of financial assets, which means in that sleeve, I can take on more risk. I can take on more in terms of growth assets like stocks. Human capital tends to be less risky than the stock market. So you can think of that segment of my balance sheet as being relatively low risk. Of course, when I get to closer to retirement, the majority of my assets have now become financial assets. And that's where I need to start backing off in terms of my exposure to risky assets. And, there's all manner of, splits that you'll see across the industry when it comes to that landing point. What percentage do I have in risky assets at retirement? It might be common for some investors to have more risk management assets like bonds and then stocks at that point. And that's a change, from where they would have been earlier on in their investment journey. So that's kind of where that theory comes from. And it just helps people think about, okay, well, in a perfect world, I would love to have just this unlimited growth. I'd love to have 100% stocks. What stocks do is just broaden out the range of outcomes. So for a given level of consumption that I want in retirement, let's say I decide I want, $50,000 to spend per year, I end up having to potentially oversave, like vastly oversave, if I'm only invested in stocks, because I don't know what that account balance is going to be like in the future. That's where those risk management assets come in. Even when they have a down year, like in 2022, like you mentioned, when interest rates rose very quickly, still doing their job in terms of over the long haul, minimizing the range of outcomes around account balance.